Given financial data, the graduate calculates the future and present value of money to inform a financial decision. By the end of this module, you will be able to explain the concept of time value of money, TVM, explain the importance of the five components of TVM as applied in a calculation, discount rate, duration, payment, present value, future value. Explain how the present value calculation is related to the future value calculation. Perform basic time value of money calculations. Discuss how compound interest impacts the future value of money, time value of money. 816. View the following video about the time value of money. This video helps explain the basic concept of TVM. Time value of money, interest, and debt finance and capital markets. Khan Academy, defining the time value of money. The time value of money is the concept that money is worth more today than it is in the future. Key points: being given $100 today is better than being given $100 in the future because you don't have to wait for your money. Money today has a value, present value or PV, and money in the future has a value, future value or FE. The amount that the value of the money changes after 1 year is called the interest rate, I. For example, if money today is worth 10% more in 1 year, the interest rate is 10%. Key terms: interest rate, I or R, the cost of not having money for one period, or the amount paid on an investment per year. Future value, FV, the value of the money in the future. Present value, PV, the value of the money today. Time value of money. One of the most fundamental concepts in finance is the time value of money. It states that money today is worth more than money in the future. Imagine you are lucky enough to have someone come up to you and say, "I want to give you $500. You can either have $500 right now, or I can give you $500 in a year. Which would you prefer?" Presumably, you would ask to have the $500 right now. If you took the money now, you could use it to buy a TV. If you chose to take the money in 1 year, you could still use it to buy the same TV, but there is a cost. The TV might not be for sale. Inflation may mean that the TV now costs $600, or simply, you would have to wait a year to do so and should be paid for having to wait. Since there's no cost to taking the money now, you might as well take it. There is some value, however, that you could be paid in 1 year that would be worth the same to you as $500 today. Say it's $550. You are completely indifferent between taking $500 today and $550 next year, because even if you had to wait a year to get your money, you think $50 is worth waiting for. In finance, there are special names for each of these numbers to help ensure that everyone is talking about the same thing. The $500 you get today is called the present value, PV. This is what the money is worth right now. The $550 is called the future value, FE. This is what $500 today is worth after the time period T, 1 year in this example. In this example, money with a PV of $500 has a FV of $550. The rate that you must be paid per year in order to not have the money is called an interest rate, I or R. All four of the variables, PV, FV, R, and T, are tied together in the equation. Don't worry if this seems confusing. The concept will be explored in more depth later. Defining time value of money is integral in making the best use of a financial player's limited funds. Key points: money today is worth more than the same quantity of money in the future. You can invest $1 today and receive a return on your investment. Loans, investments, and any other deal must be compared at a single point in time to determine if it's a good deal or not. The process of determining how much a future cash flow is worth today is called discounting. It is done for most major business transactions during investing decisions in capital budgeting. Key terms: discounting, the process of determining how much money paid/received in the future is worth today. You discount future values of cash back to the present using the discount rate. Interest rate, the percentage of an amount of money charged for its use per some period of time. It can also be thought of as the cost of not having money for one period, or the amount paid on an investment per year. Why is the time value of money important? The time value of money is a concept integral to all parts of business. A business does not want to know just what an investment is worth today. It wants to know the total value of the investment. What is the investment worth in total? Let's take a look at a couple of examples. Suppose you are one of the lucky people to win the lottery. You are given two options on how to receive the money. Option 1. Take $5 million right now. Option 2. Get paid $600,000 every year for the next 10 years. In option 1, you get $5 million, and in option 2, you get $6 million. Option 2 may seem like the better bet because you get an extra $1 million, but the time value of money theory says that since some of the money is paid to you in the future, it is worth less. By figuring out how much option 2 is worth today through a process called discounting, you'll be able to make an apples-to-apples comparison between the two options. If option 2 turns out to be worth less than $5 million today, you should choose option 1 or vice versa. Let's look at another example. Suppose you go to the bank and deposit $100. Bank 1 says that if you promise not to withdraw the money for 5 years, they'll pay you an interest rate of 5% a year. Before you sign up, consider that there is a cost to you for not having access to your money for 5 years. At the end of 5 years, Bank 1 will give you back $128. But you also know that you can go to Bank 2 and get a guaranteed 6% interest rate, so your money is actually worth 6% a year for every year you don't have it. Converting our present cash worth into future value using the two different interest rates offered by Banks 1 and 2, we see that putting our money in Bank 1 gives us roughly $128 in 5 years, while Bank 2's interest rate gives $134. Between these two options, Bank 2 is the better deal for maximizing future value. Compound interest. In this formula, your deposit, $100, is PV, I is the interest rate, 5% for Bank 1, 6% for Bank 2. T is time, 5 years, and FV is the future value. Defining single-period investments, since the number of periods, or T, is 1, FV equals PV, 1 plus I, where I is the interest rate. Key points: single-period investments use a specified way of calculating future and present value. Single-period investments take place over one period, usually 1 year. In a single-period investment, you only need to know two of the three variables PV, FV, and I. The number of periods is implied as 1 since it is a single period. Key terms: multi-period investment, an investment that takes place over more than one periods. Periods, T or N. Units of time, usually 1 year. Single-period investment, an investment that takes place over one period, usually 1 year. Single-period investment, the amount of time between the present and future is called the number of periods. A period is a general block of time. Usually, a period is 1 year. The number of periods can be represented as either T or N. Suppose you're making an investment, such as depositing your money in a bank. If you plan on leaving the money there for 1 year, you're making a single-period investment. Any investment for more than 1 year is called a multi-period investment. Let's go through an example of a single-period investment. As you know, if you know 3 of the following 4 values, you can solve for the 4th. Present value, PV. Future value, FV, interest rate, I or R. Note: for all formulas, express interest in its decimal form, not as a whole number. 7% is 0.7, 12% is 12, and so on. Number of periods, T or N. For example, suppose you deposit $100 into a bank account that pays 3% interest. What is the balance in your account after 1 year? In this case, your PV is $100 and your interest is 3%. You want to know the value of your investment in the future, so you're solving for FV. Since this is a single-period investment, T or N is 1. Plugging the numbers into the formula, you get your balance will be $103 in 1 year. This could also be solved with the TIBHA plus using the following TVM inputs: N equals 1, I slash 3 yen, PV equals minus 100, PMT equals 0, and CPT FV equals 103. Explain the importance of the 5 components of TVM as applied in a calculation: discount rate, duration, payment, present value, future value. Defining multi-period investment. Multi-period investments take place over more than one period, usually multiple years. They can either accrue simple or compound interest. Key points: investments that accrue simple interest have interest paid based on the amount of the principal, not the balance in the account. Investments that accrue compound interest have interest paid on the balance of the account. This means that interest is paid on interest earned in previous periods. Simple interest increases the balance linearly, while compound interest increases it exponentially. Key terms: accrue, to add or grow. Principal, the money originally invested or loaned on which basis interest and returns are calculated. Multi-period investment. There are two primary ways of determining how much an investment will be worth in the future if the time frame is more than one period. The first concept of accruing or earning interest is called simple interest. Simple interest means that you earn interest only on the principal. Your total balance will go up each period because you earn interest each period, but the interest is paid only on the amount you originally borrowed/deposited. Simple interest is expressed through the formula in simple interest formula. Simple interest is when interest is only paid on the amount you originally invested, the principal. You don't earn interest on interest you previously earned. Suppose you make a deposit of $100 in the bank and earn 5% interest per year. After 1 year, you earn 5% interest, or $5, bringing your total balance to $105. 1 more year passes, and it's time to accrue more interest. Since simple interest is paid only on your principal, $100, you earn 5% of $100, not 5% of $105. That means you earn another $5 in the second year and will earn $5 for every year of the investment. In simple interest, you earn interest based on the original deposit amount, not the account balance. The second way of accruing interest is called compound interest. In this case, interest is paid at the end of each period based on the balance in the account. In simple interest, it is only how much the principal is that matters. In compound interest, the amount of the balance is what matters. Compound interest is named as such because the interest compounds. Interest is paid on interest. The formula for compound interest is shown below. Compound interest. Interest is paid of the total amount in the account, which may include interest earned in previous periods. Suppose you make the same $100 deposit into a bank account that pays 5%, but this time, the interest is compounded. After the first year, you will again have $105. At the end of the second year, you also earn 5%, but it's 5% of your balance, or $105. You earn $5.25 in interest in the second year, bringing your balance to $110.25. In the third year, you earn interest of 5% of your balance, or $110.25. You earn $5.51 in interest, bringing your total to $115.76. Compare compound interest to simple interest. Simple interest earns you 5% of your principal each year, or $5 a year. Your balance will go up linearly each year. Compound interest earns you $5 in the first year, $5.25 in the second, a little more in the third, and so on. Your balance will go up exponentially. Simple interest is rarely used compared to compound interest, but it's good to know both types. Defining future value. The future value can be calculated by knowing the present value, interest rate, and number of periods, and plugging them into an equation. Key point: the future value is the value of a given amount of money at a certain point in the future if it earns a rate of interest. The future value of a present value is calculated by plugging the present value, interest rate, and number of periods into one of two equations. Unless otherwise noted, it is safe to assume that interest compounds and is not simple interest. Key terms: compound interest. Interest, as on a loan or a bank account, that is calculated on the total on the principal plus accumulated unpaid interest. Future value: when calculating a future value, FV, you are calculating how much a given amount of money today will be worth some time in the future. In order to calculate the FV, the other three variables, present value, interest rate, and number of periods, must be known. Recall that the interest rate is represented by either R or I, and the number of periods is represented by either T or N. It is also important to remember that the interest rate and the periods must be in the same units. That is, if the interest rate is 5% per year, one period is 1 year. However, if the interest rate is 5% per month rather than per year, then TORN must reflect the number of periods in terms of months. Determining future value: what is the FV of a $500 10-year loan with 7% annual interest? In this case, the PV is $500, tis 10 years, and I is 7% per year. The next step is to plug these numbers into an equation. But recall that there are two different formulas for the two different types of interest: simple interest and compound interest. If the problem doesn't specify how the interest is accrued, assume it is compound interest, at least for business problems. Using the TIBHU, plus we would solve with the following TVM inputs: N equals 10, I/7 yen, PV equals minus 500, PMT equals 0, and CPT FV equals 983.58. Compound interest. Interest is paid of the total amount in the account, which may include interest earned in previous periods. Simple interest formula. Simple interest is when interest is only paid on the amount you originally invested, the principal. You don't earn interest on interest you previously earned in practical terms. You just calculated how much your loan will be in 10 years. This assumes that you don't need to make any payments during the 10 years, and that the interest compounds. Unless the problem states otherwise, it is safe to make these assumptions. You will be told if there are payments during the 10-year period or if it is simple interest. Next, suppose we want to again find the future value of a $500 10-year loan, but with an interest rate of 1% per month. In order to get our total number of periods, T, we would multiply 12 months by 10 years, which equals 120 periods. Therefore, using the TIBHU, plus we would solve with the following TVM inputs. N equals 10x12 equals 120, I/1 yen, PV equals minus 500, PMT equals 0, and CPT FV equals 1,650.19. Calculating FV is a matter of identifying PV, I or R, and T or N, and then plugging them into the compound or simple interest formula. Key points: the present can be moved based on whatever makes the problem easiest. Just remember that moving the date of the present also changes the number of periods until the future for the FV. To find FV, you must first identify PV, the interest rate, and the number of periods from the present to the future. The interest rate and the number of periods must have consistent units. If one period is 1 year, the interest rate must be X% per year, and vice versa. Key terms: quarter, a period of 3 consecutive months, 1 quarter of a year. Calculating FV, the method of calculating future value for a single amount, is relatively straightforward. It's just a matter of plugging numbers into an equation. The tough part is correctly identifying what information needs to be plugged in. As previously discussed, there are 4 things that you need to know in order to find the FV. How does the interest accrue? Is it simple or compounding interest? Present value, interest rate, number of periods. Let's take one complex problem as an example. On July 1, 2014, you will take out a $5,000 loan for 8 years. The loan accrues interest at a rate of 3% per quarter. On January 1, 2015, you will take out another $5,000 8-year loan, with this one accruing 5% interest per year. The loan accrues interest on the principal only. What is the total future value of your loans on January 1, 2017? First, the question is really two questions. What is the value of the first loan in 2017? And what is the value of the second in 2017? Once both values are found, simply add them together. Let's talk about the first loan first. The present value is $5,000 on July 1, 2014. It is possible to find the value of the loan today and then find its value in 2017. But since the value is the same in 2017, it's okay to just imagine it as 2014 today. Next, we need to identify the interest rate. The problem says it's 3% per quarter or 3% every 3 months. Since the problem doesn't say otherwise, we assume that the interest on this loan is compounded. That means we will use the formula in the equation box below. Finally, we need to identify the number of periods. There are 2.5 years between the inception of the loan and when we need the FV. But recall that the interest rate and periods must be in the same units. That means that the interest must either be converted to percent per year or one period must be 1 quarter. Let's take one period to be 1 quarter. That means there are 10 periods. Please note that we don't really care when the loan ends in this problem. We only care about the value of the loan on January 1, 2017. Compound interest. Interest is paid at the total amount in the account, which may include interest earned in previous periods. Next, we simply plug the numbers into the equation PV equals 5,000, I equals 0.3, and T equals 10. That gives us an FV of $6,719.58. Using the TIBHU, plus we would solve with the following TVM inputs, and it equals 10, I/3N, PV equals 5,000, PMT equals 0, and CPT FV equals 6,719.58. Now let's find the value of the second loan on January 1, 2017. Again, PV equals $5,000, but this time, pretend it is January 1, 2015. This time, the interest is 5% per year, and it is explicitly stated to be simple interest. That means we use the formula in the equation below. January 1, 2017 is exactly 2 years from January 1, 2015, and since the interest is measured per year, we can set T equals 2 years. When we plug all of those numbers into the equation below, we find that FV equals $5,500, simple interest formula. Simple interest is when interest is only paid on the amount you originally invested, the principal. You don't earn interest on interest you previously earned. Since the problem asks for the total FV of the loans, we add $6,719.58 to $5,500 and get a total value of $12,219.58. Defining single period investment when considering a single period investment N is 1. So the PV is simply FV divided by 1 plus I. Key points: a single period investment has the number of periods, N or T, equal to 1. For both simple and compound interest, the PV is FV divided by 1 plus I. The time value of money framework says that money in the future is not worth as much as money in the present. Key terms: interest rate, the percentage of an amount of money charged for its use per some period of time. It can also be thought of as the cost of not having money for one period, or the amount paid on an investment per year. Period. The length of time during which interest accrues. Single period investment, the time value of money framework, says that money in the future is not worth as much as money in the present. Investors would prefer to have the money today because then they are able to spend it, save it, or invest it right now instead of having to wait to be able to use it. The difference between what the money is worth today and what it will be worth at a point in the future can be quantified. The value of the money today is called the present value, PV, and the value of the money in the future is called the future value, FV. There is also a name for the cost of not having the money today, the interest rate or discount rate, I or R. For example, if the interest rate is 3% per year, it means that you would be willing to pay 3% of the money to have it 1 year sooner. The amount of time is also represented by a variable, the number of periods in. One period could be any length of time, such as 1 day, 1 month, or 1 year, but it must be clearly defined, consistent with the time units in the interest rate, and constant throughout your calculations. FV of a single payment. The FV is related to the PV by being a percent more each period. All of these variables are related through an equation that helps you find the PV of a single amount of money. That is, it tells you what a single payment is worth today, but not what a series of payments is worth today. That will come later. In order to find the PV, you must know the FV, I, and NEN. When considering a single period investment, NEN is, by definition, 1. That means that the PV is simply FV divided by 1 plus I. There is a cost to not having the money for 1 year, which is what the interest rate represents. Therefore, the PV is a percent less than the FV. Defining multi-period investments require an understanding of compound interest, incorporating the time value of money over time. Key points: a dollar today is worth more than a dollar tomorrow, and the time value of money must take into account foregone opportunities. Single-period investments are relatively simple to calculate in terms of future value, applying the interest rate to a present value a single time. Multi-period investments require a slightly more complex equation, where interest gets compounded based on the number of periods the investment spans. As a result of multiple periods, it is usually a good idea to calculate the average rate of return, cumulatively, over the lifetime of the investment. Key term: compound interest, an interest rate applied to multiple applications of interest during the lifetime of the investment. Single-period investments: when investing, the time value of money is a core concept investors simply cannot ignore. A dollar today is valued higher than a dollar tomorrow, and when utilizing the capital, it is important to recognize the opportunity cost involved in what could have been invested in instead. With single-period investments, the concept of time value of money is relatively straightforward. The future value is simply the present value applied to the interest rate, compounded one time. When comparing this to the opportunity cost involved, the rate of return of an alternative investment during the same time is similarly straightforward. The variables involved in understanding the time value of money in these investments are present value, PV, future value, FV, interest rate, I or R. Note: for all formulas, express interest in its decimal form, not as a whole number. 7% is 0.7, 12% is 12, and so on. Number of periods, TORN. With these variables, a single period investment could be calculated as follows. T in this equation would simply be 1. Simplifying this equation, multi-period investments with multi-periods in mind, interest begins to compound. Compound interest simple means that the interest from the first period is added to the future present value, and the interest rate the next time around is now being applied to a larger amount. This turns into an exponential calculation of interest, calculated. This means that the interest rate of a given period may not be the same percentage as the interest rate over multiple periods, in most situations. A useful tool at this point is a way to create an average rate of return over the life of the investment. All in all, the difference from a time value of money perspective between single and multiple period investments is relatively straightforward. Normalizing expected returns in present value terms, or projecting future returns over multiple time periods of compounding interest, paints a clearer and more accurate picture of the actual worth of a given investment opportunity. Defining discount rate: discounting is the procedure of finding what a future sum of money is worth today. Key point: the discount rate represents some cost or group of costs to the investor or creditor. Some costs to the investor or creditor are opportunity cost, liquidity cost, risk, and inflation. The discount rate is used by both the creditor and debtor to find the present value of an amount of money. Key terms: discount, to account for the time value of money. Discount rate, the interest rate used to discount future cash flows of a financial instrument. The annual interest rate used to decrease the amounts of future cash flow to yield their present value. Discounting, another common name for finding present value, PV, is discounting. Discounting is the process of finding what a future sum of money is worth today. As you know from the previous sections, to find the PV of a payment, you need to know the future value, FV, the number of time periods in question, and the interest rate. The interest rate, in this context, is more commonly called the discount rate. The discount rate represents some cost or group of costs to the investor or creditor. The sum of these costs amounts to a percentage which becomes the interest rate plus a small profit sometimes. Here are some of the most significant costs from the investor/creditor's point of view. Opportunity cost, the cost of not having the cash on hand at a certain point of time. If the investor/creditor had the cash as he could spend it, but since it has been invested/loaned out, he incurs the cost of not being able to spend it. Inflation. The real value of a single dollar decreases over time with inflation. That means that even if everything else is constant, a $100 item will retail for more than $100 in the future. Inflation is generally positive in most countries at most times. If it's not, it's called deflation, but it's rare. Risk. There is a chance that you will not get your money back because it is a bad investment. The debtor defaults. You require compensation for taking on that risk. Liquidity. Investing or loaning out cash necessarily reduces your liquidity. All of these costs combine to determine the interest rate on an account, and that interest rate, in turn, is the rate at which the sum is discounted. The PV and the discount rate are related through the same formula we have been using. PV equals FV/ohm plus IN. If FV and NIT are held as constants, then as the discount rate increases, PV decreases. PV and the discount rate, therefore, vary inversely, a fundamental relationship in finance. Suppose you expect $1,000 in 1 year's time. FV equals $1,000. To determine the present value, you would need to discount it by some interest rate, I. If this discount rate were 5%, the $1,000 in a year's time would be the equivalent of $952.38 to you today. 1,000/0.00 plus 0.05. Key points: a period is just a general term for a length of time. It can be anything: 1 month, 1 year, 1 decade, but it must be clearly defined and fixed. For both simple and compound interest, the number of periods varies jointly with FV and inversely with PV. The number of periods is also part of the units of the discount rate. If one period is 1 year, the discount rate must be defined as X% per year. If one period is 1 month, the discount rate must be X% per month. Key terms: period, the length of time during which interest accrues. Number of periods: N represents the number of periods. A period is just a general term for a length of time. It can be anything: 1 month, 1 year, 1 decade, but it must be clearly defined and fixed. The length of one period must be the same at the beginning of an investment and at the end. It is also part of the units of the discount rate. If one period is 1 year, the discount rate must be defined as X% per year. If one period is 1 month, the discount rate must be X% per month. FV of a single payment. The PV and FV are directly related. The number of periods corresponds to the number of times the interest is accrued. In the case of simple interest, the number of periods, T, is multiplied by their interest rate. This makes sense because if you earn $30 of interest in the first period, you also earn $30 of interest in the last period. So the total amount of interest earned is simple times $30. Simple interest is rarely used in comparison to compound interest. In compound interest, The interest in one period is also paid on all interest accrued in previous periods. Therefore, there is an exponential relationship between PV and FV, which is reflected in 1 plus n. For both forms of interest, the number of periods varies jointly with FV and inversely with PV. Logically, if more time passes between the present and the future, the FV must be higher or the PV lower, assuming the discount rate remains constant. Defining effective annual rate year. Finding the effective annual rate year accounts for compounding during the year and is easily adjusted to different period durations. Key points: the units of the period, egg 1 year, must be the same as the units in the interest rate, egg 7% per year. When interest compounds more than once a year, the effective interest rate, EAR, is different from the nominal interest rate. The equation skips the step of solving for EAR and is directly usable to find the present or future value of a sum. Key terms: future value, the value of an asset at a specific date. It measures the nominal future sum of money that a given sum of money is worth at a specified time in the future, assuming a certain interest rate, or more generally, rate of return. It is the present value multiplied by the accumulation function. Present value, also known as present discounted value, is the value on a given date of a payment or series of payments made at other times. If the payments are in the future, they are discounted to reflect the time value of money and other factors such as investment risk. If they are in the past, their value is correspondingly enhanced to reflect that those payments have been, or could have been, earning interest in the intervening time. Present value calculations are widely used in business and economics to provide a means to compare cash flows at different times on a meaningful like-to-like basis. Calculating values sometimes, the units of the number of periods does not match the units in the interest rate. For example, the interest rate could be 12% compounded monthly, but one period is 1 year. Since the units have to be consistent to find the PV or FV, you could change one period to 1 month. But suppose you want to convert the interest rate into an annual rate. Since interest generally compounds, it is not as simple as multiplying 1% by 12 to 1% compounded each month. This atom will discuss how to handle different compounding periods. Effective annual rate. The effective annual rate, EAR, is a measurement of how much interest actually accrues per year if it compounds more than once per year. The EAR can be found through the formula in where I is the nominal interest rate and N is the number of times the interest compounds per year. Once the EAR is solved, that becomes the interest rate that is used in any of the capitalization or discounting formulas. EAR with continuous compounding, the effective rate when interest compounds continuously. Calculating the effective annual rate, the effective annual rate for interest that compounds more than once per year. This could also be solved using the interest rate conversion function, ICONV, on the TIBA2 plus calculator as follows. To enter the function, use 2ND2. Then use the up and down arrow keys to enter the following inputs: NOM equals 8, C/V equals 4. Scroll to the EF equals display screen and then hit CPT to get EF equals 8.24%. For example, if there is 8% interest that compounds quarterly, you plug in 0.8 for I and 4 for N. That calculates an EAR of 8.24 or 8.24%. You can think of it as 2% interest accruing every quarter, but since the interest compounds, the amount of interest that actually accrues is slightly more than 8%. If you wanted to find the FV of a sum of money, you would have to use 8.24%, not 8%. Solving for present and future values with different compounding periods, solving for the EAR, and then using that number as the effective interest rate in present and future value, PV/FV calculations, is demonstrated here. Luckily, it's possible to incorporate compounding periods into the standard time value of money formula. The equation in is the same as the formulas we have used before, except with different notation. In this equation, 8 corresponds to FV, a 0 corresponds to present value, R is the nominal interest rate, N is the number of compounding periods per year, and T is the number of years. FV periodic compounding. Finding the FV at, given the PV, oh, nominal interest rate, R, number of compounding periods per year, N, and number of years, T. The equation follows the same logic as the standard formula. Our slash n is simply the nominal interest per compounding period, and it represents the total number of compounding periods. Solving for the last tricky part of using these formulas is figuring out how many periods there are. If PV, FV, and the interest rate are known, solving for the number of periods can be tricky because n is in the exponent. It makes solving for n manually messy. The equation below shows an easy way to solve for n. Remember that the units are important. The units on n must be consistent with the units of the interest rate, I. Solving for n. This formula allows you to figure out how many periods are needed to achieve a certain future value given a present value and an interest rate. Module reference Lumen Learning 2017. Boundless Finance. Portland or Lumen Learning CC. Defining fractional time periods, the value of money and the balance of the account may be different when considering fractional time periods. Key points: the balance of an account only changes when interest is paid. To find the balance, round the fractional time period down to the period when interest was last accrued. To find the PV or FV, ignore when interest was last paid and use the fractional time period as the time period in the equation. The discount rate is really the cost of not having the money over time, so for PV/FV calculations, it doesn't matter if the interest hasn't been added to the account yet. Key terms: compounding period, the length of time between the points at which interest is paid. Time period assumption, business profit or losses are measured on a timely basis. Time value of money, the value of an asset accounting for a given amount of interest earned or inflation accrued over a given period. Up to this point, we have implicitly assumed that the number of periods in question matches to a multiple of the compounding period. That means that the point in the future is also a point where interest accrues. But what happens if we are dealing with fractional time periods? Compounding periods can be any length of time, and the length of the period affects the rate at which interest accrues. Suppose the compounding period is 1 year starting January 1, 2012. If the problem asks you to find the value at June 1, 2014, there is a bit of a conundrum. The last time interest was actually paid was at January 1, 2014, but the time value of money theory clearly suggests that it should be worth more in June than in January. In the case of fractional time periods, it's imperative to pay attention to the details. The question could ask for the future value, present value, etc., or it could ask for the future balance, which have different answers. Future/present value if the problem asks for the future value FV or present value PV, it doesn't really matter that you are dealing with a fractional time period. You can plug in a fractional time period to the appropriate equation to find the FV or PV. The reasoning behind this is that the interest rate in the equation isn't exactly the interest rate that is earned on the money. It is the same as that number, but more broadly, is the cost of not having the money for a time period. Since there is still a cost to not having the money for that fraction or compounding period, the FV still rises. Account balance, the question could alternatively ask for the balance of the account. In this case, you need to find the amount of money that is actually in the account, so you round the number of periods down to the nearest whole number, assuming one period is the same as a compounding period. If not, round down to the nearest compounding period. Even if interest compounds every period and you are asked to find the balance of the 999th period, you need to round down to 6. The last time the account actually accrued interest was at period 6. The interest for period 7 has not yet been paid. If the account accrues interest continuously, there is no problem. There can't be a fractional time period, so the balance of the account is always exactly the value of the money. Defining calculating present value, PV. Calculating the present value, PV, is a matter of plugging FV, the interest rate, and the number of periods into an equation. Key points. The first step is to identify if the interest is simple or compound. Most of the time, it is compound. The interest rate and number of periods must have consistent units. The PV is what a future sum is worth today given a specific interest rate, often called a discount rate. Key terms: compound interest. Interest, as on a loan or a bank account, that is calculated on the total on the principal plus accumulated unpaid interest. Simple interest. Interest paid only on the principal. Calculating present value, PV. Finding the present value, PV, of an amount of money is finding the amount of money today that is worth the same as an amount of money in the future given a certain interest rate. Calculating the present value, PV, of a single amount is a matter of combining all of the different parts we have already discussed. But first, you must determine whether the type of interest is simple or compound interest. If the interest is simple interest, you plug the numbers into the simple interest formula. Simple interest formula. Simple interest is when interest is only paid on the amount you originally invested, the principal. You don't earn interest on interest you previously earned. If it is compound interest, you can rearrange the compound interest formula to calculate the present value. Present value single payment. Finding the PV is a matter of plugging in for the three other variables. Inputs: future value, the known value of the money at a declared point in the future. Interest rate, discount rate, represented as either I or A. This is the percentage of interest paid each period. Number of periods, represented as an ORT. Once you know these three variables, you can plug them into the appropriate equation. If the problem doesn't say otherwise, it's safe to assume the interest compounds. If you happen to be using a program like Excel, the interest is compounded in the PV formula. Simple interest is pretty rare. One area where there is often a mistake is in defining the number of periods and the interest rate. They have to have consistent units, which may require some work. For example, interest is often listed as X% per year. The problem may talk about finding the PV 24 months before the FV, but the number of periods must be in years since the interest rate is listed per year. Therefore, equals 2. As long as the units are consistent, however, finding the PV is done by plug and chug. Variables such as compounding, inflation, and the cost of capital must be considered before comparing interest rates. Key points: a nominal interest rate that compounds has a different effective rate, ER, because interest is accrued on interest. The Fisher equation approximates the amount of interest accrued after accounting for inflation. A company will theoretically only invest if the expected return is higher than their cost of capital, even if the return has a high nominal value. Key terms: inflation, an increase in the general level of prices or in the cost of living. Comparing interest rates, the amount of interest you would have to pay on a loan or would earn on an investment is clearly an important consideration when making any financial decisions. However, it is not enough to simply compare the nominal values of two interest rates to see which is higher. Effective interest rates. The reason why the nominal interest rate is only part of the story is due to compounding. Since interest compounds, the amount of interest actually accrued may be different than the nominal amount. The last section went through one method for finding the amount of interest that actually accrues, the effective annual rate, EAR. The EAR is a calculation that accounts for interest that compounds more than one time per year. It provides an annual interest rate that accounts for compounded interest during the year. If two investments are otherwise identical, you would naturally pick the one with the higher EAR, even if the nominal rate is lower. Real interest rates are charged for a number of reasons, but one is to ensure that the creditor lowers his or her exposure to inflation. Inflation causes a nominal amount of money in the present to have less purchasing power in the future. Expected inflation rates are an integral part of determining whether or not an interest rate is high enough for the creditor. The Fisher equation is a simple way of determining the real interest rate, or the interest rate accrued after accounting for inflation. To find the real interest rate, simply subtract the expected inflation rate from the nominal interest rate. Fisher equation. The nominal interest rate is approximately the sum of the real interest rate and inflation. For example, suppose you have the option of choosing to invest in two companies. Company 1 will pay you 5% per year, but is in a country with an expected inflation rate of 4% per year. Company 2 will only pay 3% per year, but is in a country with an expected inflation of 1% per year. By the Fisher equation, the real interest rates are 1% and 2% for Company 1 and Company 2, respectively. Thus, Company 2 is the better investment, even though Company 1 pays a higher nominal interest rate. Cost of capital, another major consideration, is whether or not the interest rate is higher than your cost of capital. The cost of capital is the rate of return that capital could be expected to earn in an alternative investment of equivalent risk. Many companies have a standard cost of capital that they use to determine whether or not an investment is worthwhile. In theory, a company will never make an investment if the expected return on the investment is less than their cost of capital. Even if a 10% annual return sounds really nice, a company with a 13% cost of capital will not make that investment. Defining amortization when borrowing money to be paid back via a number of installments over time, it is important to understand the time value of money and how to build an amortization schedule. Key points: amortization of a loan is the process of identifying a payment amount for each period of repayment on a given outstanding debt. Repaying capital over time at an interest rate requires an amortization schedule, which both parties agree to prior to the exchange of capital. This schedule determines the repayment period as well as the amount of repayment per period. Time value of money is a central concept to amortization. A dollar today, for example, is worth more than a dollar tomorrow due to the opportunity cost of other investments. When purchasing a home for $100,000 over 30 years at 8% interest, consistent payments each month, for example, the total amount of repayment is more than 2.5 times the original principal of $100,000. Key terms: amortization. This is the process of scheduling intervals of payment over time to pay back an existing debt, taking into account the time value of money. Amortization schedule when lending money or borrowing, depending on your perspective. It is common to have multiple payback periods over time, multiple, smaller cash flow installments to pay back the larger borrowed sum. In these situations, an amortization schedule will be created. This will determine how much will be paid back each period and how many periods of repayment will be required to cover the principal balance. This must be agreed upon prior to the initial borrowing occurs and signed by both parties. Time value of money. Now, if you add up all of the separate payments in an amortization schedule, you'll find the total exceeds the amount borrowed. This is because amortization schedules must take into account the time value of money. Time value of money is a fairly simple concept at its core. A dollar today is worth more than a dollar tomorrow. Why? Because capital can be invested, and those investments can yield returns. Lending your money to someone means incurring the opportunity cost of the other things you could do with that money. This gets even more drastic as the scale of capital increases, as the returns on capital over time are expressed in a percentage of the capital invested. Say you spend $100 on some stock and turn 10% on that investment. You now have $110, a profit of $10. Say instead of only a $100, you put in $10,000. Now you have $11,000, a profit of $1,000. Principal and interest. As a result of this calculation, amortization schedules charge interest over time as a percentage of the principal borrowed. The calculation will incorporate the number of payment periods N, the principal P, the amortization payment A, and the interest rate R. To make this a bit more realistic, let's insert some numbers. Let's say you find a dream house at the reasonable rate of $100,000. Unfortunately, a bit of irresponsible borrowing in your past means you must pay 8% interest over a 30-year loan, which will be paid via a monthly amortization schedule. 12 months x 30 years equals 360 payments total. If you do the math, you should find yourself paying $734 per month 360 times. 360 x 734 will leave you approximately $264,000 in total repayment, which means you are paying more than 2.5 times as much for this house due to time value of money. This bit of knowledge is absolutely critical for personal financial decisions as well as for high-level business decisions. Amortization schedule example. This shows the first few installments in the example discussed above. Borrowing $100,000 at 8% interest paid monthly over 30 years. Defining perpetuity, the present value of a perpetuity is simply the payment size divided by the interest rate, and there is no future value. Key points: perpetuities are a special type of annuity. A perpetuity is an annuity that has no end, or a stream of cash payments that continues forever. To find the future value of a perpetuity requires having a future date, which effectively converts the perpetuity to an ordinary annuity until that point. Perpetuities with growing payments are called growing perpetuities. The growth rate is subtracted from the interest rate in the present value equation. Key terms: growth rate, the percentage by which the payments grow each period. Calculating perpetuities. Perpetuities are a special type of annuity. A perpetuity is an annuity that has no end or a stream of cash payments that continues forever. Essentially, they are ordinary annuities but have no end date. There aren't many actual perpetuities, but the United Kingdom has issued them in the past. Since there is no end date, the annuity formulas we have explored don't apply here. There is no end date, so there is no future value formula. To find the FV of a perpetuity would require setting a number of periods, which would mean that the perpetuity up to that point can be treated as an ordinary annuity. There is, however, a PV formula for perpetuities. The PV is simply the payment size, A, divided by the interest rate, R. Notice that there is known or a number of periods. More accurately, is what results when you take the limit of the ordinary annuity PV formula as in. It is also possible that an annuity has payments that grow at a certain rate per period. The rate at which the payments change is fittingly called the growth rate, G. The PV of a growing perpetuity is represented as where a 1 is the first payment in the series. It is essentially the same as in, except that the growth rate is subtracted from the interest rate. Another way to think about it is that for a normal perpetuity, the growth rate is just 0, so the formula boils down to the payment size divided by R. Explain how the present value calculation is related to the future value calculation. Defining present value and future value. Present value, PV, and future value, FV, measure how much the value of money has changed over time. Key points: the future value, FV, measures the nominal future sum of money that a given sum of money is worth at a specified time in the future, assuming a certain interest rate, or more generally, rate of return. The FV is calculated by multiplying the present value by the accumulation function. PV and FV vary jointly. When one increases, the other increases, assuming that the interest rate and number of periods remain constant. As the interest rate, discount rate, and number of periods increase, FV increases or PV decreases. Key terms: discounting, the process of finding the present value using the discount rate. Present value, a future amount of money that has been discounted to reflect its current value as if it existed today. Capitalization, the process of finding the future value of a sum by evaluating the present value. Future value, the future value, FV, measures the nominal future sum of money that a given sum of money is worth at a specified time in the future, assuming a certain interest rate, or more generally, rate of return. The FV is calculated by multiplying the present value by the accumulation function. The value does not include corrections for inflation or other factors that affect the true value of money in the future. The process of finding the FV is often called capitalization. Present value, on the other hand. The present value, PV, is the value on a given date of a payment or series of payments made at other times. The process of finding the PV from the FV is called discounting. PV and FV are related, which reflects compounding interest. Simple interest has in multiplied by I, instead of as the exponent. Since it's really rare to use simple interest, this formula is the important one. FV of a single payment. The PV and FV are directly related. PV and FV vary directly. When one increases, the other increases, assuming that the interest rate and number of periods remain constant. The interest rate, or discount rate, and the number of periods are the two other variables that affect the FV and PV. The higher the interest rate, the lower the PV, and the higher the FV. The same relationships apply for the number of periods. The more time that passes, or the more interest accrued per period, the higher the FV will be if the PV is constant, and vice versa. The formula implicitly assumes that there is only a single payment. If there are multiple payments, the PV is the sum of the present values of each payment, and the FV is the sum of the future values of each payment. Perform basic time value of money calculations. Defining future value, multiple flows to find the FV of multiple cash flows, sum the FV of each cash flow. Key points: the FV of multiple cash flows is the sum of the FV of each cash flow. To sum the FV of each cash flow, each must be calculated to the same point in the future. If the multiple cash flows are a fixed size, occur at regular intervals, and earn a constant interest rate, it is an annuity. There are formulas for calculating the FV of an annuity. Key terms: annuity, a specified income payable at stated intervals for a fixed or a contingent period, often for the recipient's life, in consideration of a stipulated premium paid either in prior installment payments or in a single payment. For example, a retirement annuity paid to a public officer following his or her retirement. Cash flow, the sum of cash revenues and expenditures over a period of time. Incremental cash flows, the additional money flowing in or out of a business due to a project. Future value, multiple cash flows, finding the future value, FV, of multiple cash flows means that there are more than one payment/investment, and a business wants to find the total FV at a certain point in time. These payments can have varying sizes, occur at varying times, and earn varying interest rates, but they all have a certain value at a specific time in the future. The first step in finding the FV of multiple cash flows is to define when the future is. Once that is done, you can determine the FV of each cash flow using the formula in. Then simply add all of the future values together. FV of a single payment. The FV of multiple cash flows is the sum of the future values of each cash flow. Manually calculating the FV of each cash flow and then summing them together can be a tedious process. If the cash flows are irregular, don't happen at regular intervals, or earn different interest rates, there isn't a special way to find the total FV. However, if the cash flows do happen at regular intervals, are a fixed size, and earn a uniform interest rate, there is an easier way to find the total FV. Investments that have these three traits are called annuities. There are formulas to find the FV of an annuity depending on some characteristics, such as whether the payments occur at the beginning or end of each period. There is a module that goes through exactly how to calculate the FV of annuities. If the multiple cash flows are a part of an annuity, you're in luck. There is a simple way to find the FV. If the cash flows aren't uniform, don't occur at fixed intervals, or earn different interest rates, the only way to find the FV is to find the FV of each cash flow and then add them together. Perform basic time value of money calculations. Defining present value, multiple flows, the PV of multiple cash flows is simply the sum of the present values of each individual cash flow. Key points to find the PV of multiple cash flows. Each cash flow must be discounted to a specific point in time and then added to the others. To discount annuities to a time prior to their start date, they must be discounted to the start date and then discounted to the present as a single cash flow. Multiple cash flow investments that are not annuities, unfortunately, cannot be discounted by any other method but by discounting each cash flow and summing them together. Key terms discount: to find the value of a sum of money at some earlier point in time. To find the present value. Net present value: the present value of a project or an investment decision determined by summing the discounted incoming and outgoing future cash flows resulting from the decision. Present value, multiple cash flow. The PV of multiple cash flows follows the same logic as the FV of multiple cash flows. The PV of multiple cash flows is simply the sum of the present values of each individual cash flow. Sum FV. The PV of an investment is the sum of the present values of all its payments. Each cash flow must be discounted to the same point in time. For example, you cannot sum the PV of two loans at the beginning of the loans if one starts in 2012 and one starts in 2014. If you want to find the PV in 2012, you need to discount the second loan an additional 2 years, even though it doesn't start until 2014. The calculations get markedly simpler if the cash flows make up an annuity. In order to be an annuity and use the formulas explained in the annuity module, the cash flows need to have 3 traits. Constant payment size payments occur at fixed intervals. A constant interest rate. Things may get slightly messy if there are multiple annuities, and you need to discount them to a date before the beginning of the payments. Suppose there are 2 sets of cash flows which you determine are both annuities. The first extends from 1/1/14 to 1/1/16, and the second extends from 1/1/15 to 1/1/17. You want to find the total PV of all the cash flows on 1/1/13. The annuity formulas are good for determining the PV at the date of the inception of the annuity. That means that it's not enough to simply plug in the payment size, interest rate, and number of periods between 1/1/13 and the end of the annuities. If you do, that supposes that both annuities begin on 1/1/13, but neither do. Instead, you have to first find the PV of the first annuity on 1/1/14 and the second on 1/1/15, because that's when the annuities begin. You now have 2 present values, but both are still in the future. You then can discount those present values as if they were single sums to 1/1/13. Unfortunately, if the cash flows do not fit the characteristics of an annuity, there isn't a simple way to find the PV of multiple cash flows. Each cash flow must be discounted, and then all of the PVs must be summed together. For example, discuss how compound interest impacts the future value of money. Video. Introduction to Compound Interest, 637. View the following video to learn about the basics of compound interest, with examples of basic compound interest calculations. Video. The Rule of 72 for Compound Interest, 910. In the following video, the author describes how you can approximate the question, how long will it take to double your money, by using the Rule of 72 for compound interest.